In this chapter, we're going to talk about financial assets. Assets that are primarily cash or cash equivalents or receivables, those types of items. And as an example, we start with Apple. So Apple obviously makes iPhones and iPads and other Macs and other information. They do this throughout the world. And you might think that most of the resources are tied up in plant assets. But if you look at the balance sheet, a recent balance sheet suggests that 38 billion of that is in property, plant, and equipment. They mostly don't manufacture their own, and so own devices, but they do have a lot of assets, and only 11% of those are in property, plant, and equipment, whereas most of the rest is in financial assets. And so we're going to learn about those today. Those financial assets include cash, cash equivalents, marketable securities, and those are things like bonds or stocks. And marketable means they're ready to be traded, or accounts receivable would be the most liquid financial assets. The question is always, how much cash should it have? And certainly you want to have enough cash to meet obligations as they come due. But if cash is just sitting there and not invested, sometimes it doesn't make sense to just have it there sitting. And so you probably want to invest it in something short term. You want to have cash available as bills come due, or there's a merger or acquisition you might make that might cost millions or billions of dollars. And so you want to make sure that you have those, that cash available. Financial assets, as we just mentioned, is not just cash, but short-term investments and receivables. And these are those items that are easily and directly convertible into known amounts of cash. So short-term investment, you could take and immediately sell today, very liquid. Receivables, you actually can sell those as well, but they're likely to be turned into cash quickly and effectively. So you'll see that, for example, accounts receivable is money owed from customers, then it ends up being paid and becomes cash and cash equivalents, and then we use that cash to make cash payments. But if it's not needed yet for cash payments, we may want to invest it temporarily into some short-term marketable securities and then sold as cash as needed. We might also need that cash to pay dividends. And so you might see that there. In terms of valuation, financial assets are shown at their current values, meaning the amount of cash that the assets might represent. And so current value is however measured differently for each type of financial asset. So the current value of cash is just the amount of cash you have, right? And it could be in a savings account or a checking account and just its amount. Most short-term investments will appear on the balance sheet at their current market value. So if the stock price goes up or the stock price goes down or the bond valuation goes up or down, we're going to use those to measure it at its current market value. Accounts receivable is measured or reported or valued at its net realizable value. And that is the amount the management estimates to be collectible. So some customers don't pay, and you can kind of expect that already. And so we're going to deduct what they don't expect to pay, what we don't expect to receive. In summary, we look and see that there's these three types of financial assets, and here is the way they're valued on a balance sheet. So let's start with cash. Accountants define cash as money on deposit in banks and any items that banks will accept for deposit. They can be coins, they can be cash, they can be checks, they can be credit card receipts that are readily convertible into cash, and we'll see all those. So most companies maintain several bank accounts, and they'll also have a little bit of cash on hand. And this is going to be governed in the cash account as a control account. And then you're going to have some details, like we talked about in prior chapters, of a subsidiary ledger that kind of shows where all of these are. Is it at a bank? Is it a savings account? Is it a money order? Is it money that's just come in and be reflected there? We also have cash, and sometimes you'll see the word cash and cash equivalents. And cash equivalent means it's equivalent to cash. So it's very safe, it's stable market value, and it matures within 90 days of the acquisition. And typically 90 days would be associated with US Treasury bills. There is a 90-day Treasury bill. And so if it's 90 days or less, you're going to include that as a cash equivalent. Money market funds are essentially funds held at a investment firm that can be invested or returned to you immediately, or high-grade commercial paper. And so commercial paper is really very short-term loans that might be made, like, hey, I need $5 million tonight. Well, you're going to go and borrow that and say, I will return it in 2 days. And so you're going to get, or if you're loaning it to someone else, that's going to be considered an asset. If you owe someone else, it's going to be considered a current liability, right? Now, restricted cash is means it's not available for the normal operating needs. It can't just be used for whatever. It's going to be earmarked or protected, essentially, for the repayment of a non-current liability. For example, if you were a bondholder and the bond was about to be due, or a loan about to be due, you'd want to make sure there's going to be cash available when it does come due. And if it's just used for everything else and not saved or kept for that particular purpose, then it might not be there when needed. And so oftentimes loans or bonds have a compensating balance, a minimum average balance that must be maintained. And so this protects the giver of the loan, or the giver or the maker of the bond. And so that's going to be included in investments and restricted funds. And probably a note will be put in the footnotes. We may also have a line of credit. And that's something where in advance we've gone to the bank and negotiated and said, hey, because of the way our business works, we might make products in a certain time of the year and then say we sell it at the holidays. And so we're at a really low balance. And so a bank might work with us and say, hey, you can have $5 million, up to $5 million. You'll only be charged on the amount that you have outstanding, but that will be there available. And so that's one of the ways a company will make sure it has the cash on hand. Now, most, particularly big corporations, have something called cash management. And that's typically a treasury function. And what they do all day is just plan cash. They figure out, okay, when are the big payments coming in, the collections happening, and when is payday, or when is the loan due. And so they're going to be managing cash and making sure it's not just sitting there, that it's invested if it needs to be invested, or available to make the payments when it's time to make those payments. And so those would be some objectives of cash management. That we know how much cash, we've reflected cash receipts and cash disbursements. We're minimizing loss, and so we're managing that. And then anticipating the need for borrowing and making sure we don't have unnecessarily large amounts of cash that could be invested in the short term. We do have certain internal controls over cash, and that is to prevent fraud. It is to efficiently manage cash, make sure we are accurately accounting for and reporting transactions, and making sure we are anticipating the need for borrowing, and making sure that we have adequate cash on hand. And so those are some of the steps we're going to have. Now, the major steps in internal control is, first of all, we call it separation or segregation of duties. And that is separating the handling of the cash, who actually has access to cash, who can hold it. And that's going to be separate from those that maintain the accounting records. Because if they could handle cash and say, hey, we never got it, I just put it in my pocket. And so typically Treasury handles cash, and accounting will record or maintain the accounting records. And so there's some controls in place to make that happen. We also will prepare cash budgets and reflect on that, and prepare, a listing, some detail of the cash receipts and how it was received. And this is the way we establish internal control over the financial assets, specifically cash. Things like requiring all cash be deposited daily. And so it's not sitting there in the vault or in the desk. That all payments are made, by Venmo or by check. And so there's a consistent way that things are paid, consistent process. That we authorize and verify payments before they're made and get a proper approval. That we reconcile bank statements with the accounting records, and we'll talk about that on the next slide. So as we reconcile the bank statement, we want to make sure that the differences between the balance shown in the bank and the balance shown on our own records are the same, or at least can be reconciled. That is because the bank and the depositor, or the bank and the company, each have separate records, and they just need to make sure and verify that they are in agreement. And so that would be why reconciliation would be important. If there are differences, there might be due to outstanding checks. So someone wrote me a check, and 2 months later they said, "Hey, you never deposited." Okay, that is an example of an outstanding check. Or perhaps deposits are in transit, and that just means, hey, they got there after hours, or it takes, it's a large amount and it takes a while to go through the process. And so these are reasons there might be a difference between the bank balance and the company's balance, or the GL, general ledger balance. And so here's an example of a bank statement. And you can kind of see what the previous balance was a year ago, the transactions that occurred, and the checks or Venmo or other checks that had been written. And so you can kind of see the beginning balance and the ending balance. And this would come from a bank. We have now kept our own records that would be included as well. We also see some things here like DM has a debit memorandum, so some money was taken out. We have NSF, means insufficient funds, so someone's check bounced, there wasn't enough funds to pay it. SC would be a service charge. The bank's going to charge certain amounts to service your bank account. INT would be a payment for interest, that maybe we have some items, some cash in a certain savings account of some sort, and so we're receiving interest on a monthly basis. And here's also a credit memorandum. And so those are some items that are reflected by the bank that are probably and likely not recorded yet by the company. And so those need to be reconciled. So here's the service charge. They're going to charge an amount. Here's some insufficient funds because when they went to draw on the customer's account, there was not sufficient funds to make that payment. And so we call that NSF, or non-sufficient funds. Credits for interest earned. Okay, so they have either their checking account or savings account or other investment accounts pay interest. So we have some credit. And then some other miscellaneous charges, that actions they might take that require an adjustment to the balance. And so in steps in preparing a bank reconciliation, we're going to have our own listing in our accounting records, and we're going to have a bank statement that has its amount. And we're going to just see, are they one and the same, or are there some deposits that we've recorded, but not yet, we meaning the company, but not yet recorded by the bank. The same thing for outstanding checks. So typically the company would have a detailed record of the checks, but if they have not yet arrived at the bank, then they don't know about them, and that is a needed reconciliation item. So those are the first two steps: outstanding deposits and outstanding checks. All right, next, add to the balance per the depositor's accounting records any differences. So is there a credit? Is there a debit? So you can see those items including there. Something that's been issued by the bank but not yet reflected by the depositor by the company. So make appropriate adjustments to correct any errors, or reconciling items to the bank statement, and then determine if there needs to be an adjusted balance. And finally, particularly those items that were recorded by the bank, still need to be recorded by the depositor or the company. And so let's do an example. Here's an example for Parkview, and we can see its balance is 5,017. And I'm going to go to the next slide just to see that. So here's the 5,017. Cash ledger on the date shown was 4,262.83. So that amount is shown here, and that's the balance per depositor's record. Okay, so we see that, and those are the amounts that need to be reconciled. All right, so let's go back here. 4 outstanding checks, 717.75, and here are those. Here's the deposit that was made after banking hours the last day of the month. So that's the outstanding deposit. And that shows up here. And so we're going to add to that balance, subtract outstanding balance, and that's going to be the adjusted cash balance per bank. And now we're going to do the same thing for the depositor or Parkview company's records. And so we need to reflect, let's see. Interest was paid. There was insufficient funds for 5025. So we see that there. Here's the insufficient funds. Here's the interest earned. Here with 2474. We can see those items included there. And we can go and see here is the bank collects a non-interest bearing note for 500. And so we can see that there. Here it is. That needs to be added. The bank knew about it. We did not as a company. And it looks like there was an error made that cleared the bank for 85, but we had recorded it for 58. And so the difference between those, let's see, 85 and 58, the difference there is $27. So that's there, and the service charge. So you can see adjustments are being made per bank balance and I'm going to call it GL balance, or per depositor's records. And you can see if we've reflected everything in our 6th step. And so let's go back to our 6th step here. We're going to see if all of these items have been included and see that the adjusted cash balance is the same for both. Now, we're not quite done because we need to go and make these adjusting journal entries. These are things the bank knew that we didn't know. So they knew they collected a note, they collected interest revenue, they charged us a service charge, there was an accounts receivable, and there's that adjustment in the telephone expense that needs to be reflected. So you can see those items there. So from beginning balance per bank, beginning balance per book, and we're seeing how those differ and need to be reconciled. The next item we're going to discuss is short-term investments. So these short-term investments are typically marketable securities. These are items that can be readily traded and easily traded. And so you can just go to the market and say, hey, I want to sell these. And so typically marketable securities or items are listed as a current asset because management intends to hold them for just the current period. However, if management plans to hold them longer than in our classified balance sheet, we're going to reflect those as a non-current asset. And so we can see examples of amounts invested by these companies and how big that is for each of those. So Microsoft at this point in time had $116 billion in marketable securities. Well, that might seem like an awful lot of money, and it is, but if they go and purchase another company or need to make a major investment, they may need that cash available to them. And so they're each trying to optimize the amount of cash on hand. So how do we purchase marketable securities? Well, the journal entry is a debit to those marketable securities. It's an asset, and we're going to pay for it using cash. And so we can see, what those look like. 4,000 shares, $49.50 plus the 2,000 commission represents 200,000. So that's the purchase. And as revenue comes in, we're going to debit cash and credit dividend revenue. And so that'll be like interest, but in this case, we hold stock, and they pay stock, pays dividends, and we'll reflect that here as an item, and that will appear. The dividend revenue will appear as a revenue on the income statement. Now, it comes a little later, and we decide to sell it. We bought it essentially for $50, and we're selling it for 52 less the brokerage fee. And so we can see, here's the money we bought in. We had an $800 gain. And so that's going to show up as an other gain or loss for the company. And we can see that is an increase in, essentially increase in revenue. We think of it like a revenue item. And that will be the credits, and we receive a debit for cash. And so we can see with the difference there and see how the gain was calculated there. We could also sell some of those at a loss. And so here, instead of, we bought it for 50, essentially we got it for, we sold it for 48 plus less a commission. And so the loss was for $14.50. So we got $28,550. That's reflected here. And we can see that there, but it costs us essentially $30,000. And so we have a loss. And look, this debit is like a debit, like an expense. And so you can see how that might occur. Now, as you recall, these are valued in the balance sheet at their current market value. And so at the current market value, it says, hey, before any adjustment, we had 145,000 investment. But at the end of the year, December 31st, is valued at 136,300. So we record an unrealized holding loss. Unrealized means we haven't traded yet. It's just on paper. But because we value it at its current value, we need to reduce the value of the marketable securities and recognize an unrealized holding loss for that $8,700. And you can see what that looks like here. Here's the amount reflected at current value, and that's 136,300 reflected there. And that's at current value. In the US, only equity investments have an active market value. If they're, for example, you might make an investment in a company that's not traded on a market, a private company, and those don't have a ready market available. And so those would be different. But under international standards, even unlisted or private companies with no observable value are carried at an estimate. So they're going to estimate what it is. And so that's just a little bit different. US private would be valued at cost. International, they're going to make an estimate of its current value. The next financial asset we're going to cover is accounts receivable. And accounts receivable is, we believe that we will sell more in the US and perhaps around the world if we can do it on credit. If people don't have cash on hands, we still want to sell it to them and then ask them to pay it back within a period of 30 days or 60 days or whatever it might be, depending on the terms that might be provided. And so a credit sale might be made, and we might go through a period of time and determine that some of the receivables are not collectible. And so the question is, what do? Well, we want to match any expenses, and if it's not collectible, then we need to match that bad debt expense or uncollectible debt expense with the sale. And so we'd want it to be in the same period if possible. And so let's assume that world famous toy company begins business on January 1st. And at January 31st, they have $250,000 in accounts receivable. But we look at all the accounts of people that owe us and guess that 10,000 of those accounts might ultimately prove to be uncollectible. So here's an example of an estimate. And so we're going to go ahead and debit that uncollectible expense in the current period because we're trying to match that with the revenues of the period. And so you can see how that might be reflected. We said 250,000 accounts receivable, but 10,000 is included in an allowance for doubtful accounts. Now, the allowance for doubtful accounts is a contra account. It in essence reduces accounts receivable. Now, we said accounts receivable is valued at net realizable value. That's the amount of cash we expect to receive. So the 250,000 less the $10,000 allowance means our net realizable value is 240,000. So we can see what that looks like. Well, now it's a little bit later, and we note that one of our customers, Discount Stores, has gone out of business, and the 4,000 they owed us is now worthless. They're not going to pay. They've gone bankrupt or gone out of business. And so we're going to say, hey, let's reduce that allowance by $4,000, and let's take the accounts receivable off the books. So that would be how we'd write off an uncollectible account. So after that write-off, now we have $4,000 less in receivables, and we have $4,000 left in allowance. And so the net realizable value is still going to be that $240,000. So we can see what that might look like. Well, there's a couple of different approaches we can use, a balance sheet approach or an income statement approach that could be used to estimate these credit losses. A widely used method is an aging analysis. And essentially, the estimate is the longer an account is past due, the longer it's been since it's been paid, the more likely it will never be collected in full. So we're going to do some type of an analysis. And so let's say, hey, Valley Ranch has $100,000 worth of receivables. Some are not yet due and others are past due. And if it gets more than 90 days past due, we expect that 50% of them will be uncollectible. And so based on these percentages we've got by recent experience and how well the economy is doing, so we're going to have an estimate of the uncollectible account based on this aging schedule. And then we're going to use that to make a journal entry to reflect that amount. Okay, so we have used this to figure out what we want the credit balance to be. And we want the balance to be 5680. That number comes right from the last screen right here, 5680. We see that there. But as of December 31st, the balance was 4,000 and we want it to be 5680. So that allowance needs to be increased by 1680. And so to do so, we're going to debit this uncollectible accounts expense and credit the allowance to get up to the balance of 5680. So we can see what that looks like. Sometimes a receivable that has been written off later becomes collectible. Hey, surprise, surprise. Even though we thought they'd never pay, they actually end up paying. And if that happens, we're going to go ahead and write off the accounts receivable because we didn't think they would pay. And so we have this allowance and this accounts receivable, and in essence, we wrote it off. But as we collect something that was previously written off, we can go ahead and reverse that entry and recognize the cash that was received. Companies that use the direct write-off method do not use a valuation account. The direct write-off method is not consistent with GAAP. And so unless the accounts receivables and uncollectible accounts are not material. So generally not GAAP, but might be done if they are immaterial. Okay, so advantages of credit card sales. Well, very easy to pay, right? And we don't need to go look at someone else's credit. They've already done that. Hey, we don't have to maintain a receivable. We don't have to go do the collections later. It's just a credit card sale. And so that's why we'd use that. Notes receivable and an interest revenue. So we might make a loan to someone, or maybe they can't pay, and we say, okay, let's have terms and set up and have you sign a formal note that says you will pay. And so that would be an example there. And so here would be an example of a note made for $200,000, and it looks like it's going to pay 6% annually, and it's going to be made, Pacific Rim is going to promise to pay that money. So as time goes on, that note incurs interest, and the borrower says, I will pay you, and the lender, whoever's lending the money, receives interest revenue. And we're going to use this formula to compute what was the amount of the loan or the note, what was the rate of interest, typically an annual rate, and how much time has passed or been used up. Okay, and so we can see those numbers multiply by each other. The principal times the annual rate times the amount of time. Okay, so we can see that. And so this might be for a full year because it's an annual rate. This one might be for 4 months instead of a year. So 4 divided by 12, a third of the year has passed. A third of $12,000 is $4,000. So we can see what that looks like. And these would be the necessary journal entries made to reflect that first the note receivable. Marvin White couldn't pay us, and so we set up a formal note. And so we took the receivable off the books and reflected a note receivable. And then as interest was due at this 6% interest, $60,000 principal, 6% interest, 1 month or 1/12 of a year for $300 interest, and that has not yet been paid. So we're going to debit interest receivable and reflect the interest revenue that was received. Then finally, when it was paid 3 months after the note, we're going to say, okay, let's go ahead and collect the full amount. Here's the last 2 months, that's $600. Here's that first month that was reflected in December. And to satisfy the loan at the end of the 3 months, $60,900 will be paid, which is the principal of the note, the December interest, and the interest over January and February. All right, if a note receivable defaults, the holder of the note transfers the amount due from the notes receivable account back to an account receivable, and so it transfers back. Now, obviously, that's bad news. We're going to go and bother them and get them to collect, but it's going to move back to accounts receivable because they still owe us. Now, we have a couple ratios we use, and this essentially tells us how good we are at collecting, and it compares annual net sales to the average accounts receivable. And it's a turnover rate. So the quicker the turnover, the better. And also, how many days does it take to collect? And this will be used to judge the liquidity of the accounts receivable.